You know, tax season can feel like this huge, stressful puzzle. But what if you had a clear guide to help you put all the pieces together? Well, in this explainer, we're going to break down all the essential prep work to turn that tax anxiety into pure confidence. So let's dive right in. Look, for pretty much everyone, but especially if you're new to Canada, the big question is just, where do I even begin? It can feel so overwhelming. But here's the thing, the goal isn't to become a tax expert overnight. Nope. The goal is to become the chief financial officer, the tax CFO, of your own life. And that journey starts with understanding the big picture. Okay, so first things first, let's talk about you, your personal life, your family, because in Canada, your tax return isn't some isolated document about your income. Oh no, it's deeply woven into your household structure, your marital status, whether you have kids. All of this has a massive impact on your bottom line. This is a huge one, right? A question I hear all the time. And hey, if you're coming from another country, the way Canada handles this might really surprise you. So how does it actually work when you're part of a couple? So what's so fascinating about this slide is the difference between form and substance. On paper, you file individually. Every person has their own separate tax return. But in reality, the CRA, that's the Canada Revenue Agency, they assess you jointly. They look at your total household income to figure out if you qualify for big benefits, like the GST credit or the Canada Child Benefit. So what does that really mean for you? It means you absolutely have to coordinate with your spouse to make sure your family's tax situation is as good as it can be. And hey, this isn't just for legally married couples. The CRA is super clear about what a common law partnership is. If you've lived together for 12 consecutive months, or if you live together and you've got a child, then for tax purposes, you're considered common law. You have all the same obligations and benefits as a married couple. It's that simple. All right, what about the kids? This is actually pretty straightforward. If your child has zero income, they don't have to file. Easy. If they do have some income, maybe from a part-time job, then yes, they must file their own return. But listen up, here is a huge pro tip. It is highly, highly recommended that they file a tax return the year they turn 18, even if they have no income at all. So why would you do that? Well, it's because this gets them into the system and establishes a tax record with the CRA. That's what they need to start receiving benefits like the GST/HST credit as soon as they turn 19. Okay, moving on to Section 2. Let's get into what I think are the most powerful tools the government gives us to manage our taxes. We're talking about your registered accounts, the secret weapons for saving and investing way more efficiently. This table is just a fantastic cheat sheet. You've got the RRSP, your classic retirement tool where you get a tax deduction now and pay the tax way down the road. Then there's the TFSA, which is all about tax-free growth for whatever you want to save for. The new kid on the block is the FHSA, a total game changer for buying a first home. You get a tax deduction and tax-free withdrawals. It's the best of both worlds. And of course, the RESP for education savings, which comes with that amazing bonus of free government grant money. Okay, but let's pause here and zoom in on the TFSA for a second. Because there is a super common and honestly a very costly mistake that a lot of people make. It all comes down to this one question. If you take money out of your TFSA, can you put it right back in during the same calendar year? The answer, and I can't stress this enough, is a hard no. This slide lays out the trap perfectly. So imagine this, you put in your full $7,000 for the year, then life happens and you pull out $3,000. Now, your brain's going to tell you, great, I've got $3,000 of room again. But nope, that's not how it works. That $3,000 of contribution room only gets added back on January 1st of the next year. If you put that money back in the same year, the CRA will see it as an overcontribution and you will get hit with penalties. It is a critical rule to remember. All right, Section 3. We've talked family, we've talked accounts. Now it's time to roll up our sleeves and get into the nitty-gritty. The document hunt, the paper chase. Trust me, getting all this stuff together before you start will save you a world of pain later. So the absolute foundation of your tax return is going to be your T-slips. Think of these as official report cards for your money. Your boss sends you a T4 for your salary. Your bank sends a T5 for any interest you earned. And if you have investments, your brokerage will send you things like a T3 or a T5800. Just keep an eye on your mailbox. These usually start rolling in around February. And that, of course, leads to a really important question. What if you made some money? Maybe you did a little side gig or earned a few bucks in interest, but you never got an official T-slip for it. Can you just kind of sweep it under the rug? Let me be crystal clear on this. Yes, You absolutely 100% have to report it. You have to understand, the law puts the responsibility squarely on your shoulders as the taxpayer to report all of your income from all sources worldwide. It doesn't matter one bit whether you got a piece of paper for it or not. Okay, to make this whole paper chase thing a bit easier, think of this as your pre-flight checklist. You're going to need all your personal and family info like SINs, gather up every single T-slip, make sure you have records of any other income, dig up all those receipts for things you can deduct like RSSP contributions or childcare. And definitely grab last year's Notice of Assessment, your NOA, because it has key info like your RSSP limit. And finally, have your bank account info ready for that sweet, sweet direct deposit refund.
And here we are, our final prep step. Once you've got all your information in a nice, neat pile, you've got to decide on your game plan. How are you actually going to get this thing filed?
So you really have two main roads you can go down here: doing it yourself with tax software or hiring a tax professional. As you can see, software is awesome for simpler returns. It's cheap and you're in the driver's seat. But you have to remember, it's a calculator, not a consultant. It only knows what you tell it. A pro is probably better if your situation is complex, but it costs more. And here's the kicker, and this is so important. Even if you pay a pro, at the end of the day, you are still the one legally on the hook for everything in that return. And that just brings everything full circle, doesn't it? I love this quote because it just nails the entire mindset we're talking about. You don't have to be the person physically typing numbers into the boxes, but you should be the CFO. You should understand your own financial story well enough to direct the process, to ask smart questions, and to feel confident that it's all being done correctly.
Look, by taking these steps, getting your family info straight, understanding your accounts, gathering all your documents, and picking your filing method, you're doing so much more than just getting ready for tax season. You are taking active, meaningful control of your financial life. It's not about filling out forms. It's about stepping into that role. So, the real question is, are you ready?